Can your investments have a positive impact on the world? At Standard Chartered, we believe money can be a force for good. Through your sustainable investments with us, we're financing hospitals that are the heartbeat of local communities, funding clean energy to make electricity more accessible, and investing in innovative solutions to clean polluted marine habitats. Sustainable investments that benefit you and parts of the world that need it most. We're Standard Chartered, and we're here for good.
Good afternoon, everyone, and welcome to Standard Chartered's second Global Credit Conference in virtual format, and to our much anticipated discussion, Evolution in Bank Issuance. With me this afternoon are four of the most established capital markets experts focusing on banks. So without further ado, I'd like to welcome Paddy Clerkin, Senior Managing Director, Group Funding and Investor Relations at Emirate NBD. Paddy has been with the bank since 2007, and prior to joining, he worked in London as co-head of Global Operating Company Ratings team at Fitch. And prior to that, he was part of the Structured Investment Group at JP Morgan, where he looked after capital management and risk. With Patrick, we have Miray Mominoglu, Managing Director and Head of Term Funding at Barclays in London. After holding senior roles as a commercial banker in Turkey and later in Romania, he spent more than a decade with JP Morgan and with Barclays in debt syndicate in London, focusing on financial institutions, and he took up his current role in 2015. With Miray and Paddy, we have Mathieu Lorifern, Portfolio Manager at PIMCO. Mathieu joined PIMCO in 2005, and he's responsible for financial and corporate credits across the capital structure, and he focuses on high yield and bank capital. Mathieu also co-manages PIMCO's dedicated fund for bank capital instruments. And last but not least, we have Fred Davis, Executive Director, Head of FIG Capital Solutions and Head of FIG DCM Americas at Standard Chartered. Fred is responsible for advising our clients on regulatory capital developments, on balance sheet optimization, as well as structuring new capital instruments. And Fred also heads our financial institutions coverage in the Americas, so that includes the US, Canada, and Latin America. Welcome to all of you, and thank you for agreeing to join our discussion this afternoon. And thank you to some of you for being actually panelists for a second year running. In terms of admin, we have about 45 minutes for our discussion. And I will start by asking a number of hopefully topical questions, and as should time permit, we will also address anything that may come from our audience. So with that being said, shall we start with the obvious topic, COVID? I think last year we can agree that with the regulatory framework has definitely been dominated by forbearance. And what I'm interested to hear from you is what has been the impact on your institution, and more importantly, as these measures are starting to be lifted, what do you foresee will happen to your institution going forward? So if I could start with Patrick and Miray, we'll take it from there.
Yeah, lovely, Anna, and thank you very much for having me on your panel and for joining. In terms of the impact, I think when you compare it to the global financial crisis of 2008, 2009, the actions from central banks globally has been much more effective. It always, having lived through 2008, 2009, it always seemed that we were sort of playing catch up. And I think the actions that have been taken by central banks in supporting, and indeed governments in supporting banks, has been very much more proactive. Within the UAE, for example, there were both capital, liquidity, and credit support measures put in place, and they have really had the desired effect. Very early on, it became apparent that this was not going to develop into a liquidity crisis, and in fact, liquidity has been abundant ever since then. There have been some extension in those support measures, and you mentioned about, is there any impact from the roll-off? From our point of view, we received zero-cost funding in order to pass that on and give temporary relief to some of our customers who were experiencing cash flow disruption because of COVID. Over half of that funding has already been repaid, and we can see an amortization profile coming through. So it's really had the desired effect of giving these customers a time out and to avoid credit issues arising. Now, I don't see, because of the very nature that it's amortizing off and customers are actually repaying that. As I said, over half of the customers have repaid. I don't really see a cliff effect arising from that. Indeed, it's been extended up to the end of the year and even into next year for new loans. But again, as I say, the utilisation rate of that is dropping, reflecting that that it doesn't need the same utilisation and the support. That we don't need to provide the same support that we provided in the past. So all those measures, again, I look at capital and liquidity. There were temporary relief measures put in place there. Most banks haven't actually, continued to operate at the previous minima and haven't taken advantage of that. So I don't anticipate that as we as the support mechanisms roll off, I don't think it's going to have an impact on many banks.
Mira, would you like to add anything to that?
Sure. No, yes. Thank you for that. And as you mentioned, since early 2020, our regulators have demonstrated tremendous flexibility to adapt the regulatory framework to the rapidly deteriorating environment during this crisis in order to support the banking system through various forbearance measures. Obviously, most of these forbearance measures are only temporary, and some have already expired, like the PVA relief. Probably the most notable one is the 100% IFRS 9 transitional relief on modified Stage 1 and Stage 2 charges post-December 19. They are now applied until end of 2021. For us, what did this mean? We printed a CET1 ratio of 14.6 as of first quarter of 2021, and our ratio benefited from this measure up to about 70 basis points. Going forward, our CET1 target range remains 13 to 14%. And needless to say, our capital planning allows not only for impairment stage migration, but also plans for the amortization of this relief. So I think very meaningful, very timely measures. They will be unwound, and I think it's a transparent process. And banks like us and others, I think, will be well prepared and be planning accordingly.
Agreed. Maybe continuing on the topic of regulation, but moving more to the primary market angle of it. There haven't been many changes requested by regulators to T's and C's of capital instruments, but we have seen the first South African Tier 1 a very short while ago. Well, I'm wondering if emerging markets AT1 issuance picked up, as has been speculated for a number of years, how will established markets be impacted? And maybe I can come back to you if that's okay, Mirai.
Yeah, sure. I have seen the ABSA trade, and I think it seems to have gone really well. I'm actually interested. I'm sure Paddy will talk about whether the UAE has some plans as well. But look, the more the merrier, I think. It's a good development. I think the market has grown and matured. I hope Mathieu agrees immensely over the past years. If we can give investors more choice, so much the better. Hopefully new issuers from the emerging markets can try to look at some of the Western practices and the best practices, if you will. But I guess the point is, I don't think there would ever be a crowding out that Western issuers would worry about. I still think there is a very decent amount of money globally earmarked for deeply subordinated securities. So if I think investors get more choice, that's better for the development of the market. That's my view.
Yeah, Miri, I would certainly agree with that. And I think that, for a lot of investors, they get comfortable with credit, and then whether they're in the senior portion or in the Tier 1 portion or Tier 2, they almost view it as, I'm happy with this credit, but I can get a pickup by sort of going into Tier 2 and Tier 1. You mentioned, within the UAE, there's been a sort of flurry of issues over the last 3 or 4 years. A lot of that was actually to do with, as we moved to a Basel III framework, there was a retirement or a calling of some of the old style instruments that were no longer Basel III and issuance of new instruments. In fact, we were, you mentioned the South African Tier 1, additional Tier 1, we were in the market the same day and completed our sort of final replacement of old style instruments. So I'm not sure, I do think that it's, when you see the appetite for these instruments, I do think that it is, an attractive, it's attractive for banks to issue. It's also, offers an attractive yield for investors who get comfortable with the credit. There's a nuance within the UAE, for example, that it doesn't make much sense for us to issue Tier 2 notes going forward. So for us, it's more senior or Tier 1. But, I think given the low interest rate environments that we have at the moment, I think you will see more banks looking to take advantage of the low interest rate environment and possibly issue Tier 1. As I say, I don't expect too much more from the UAE because most of that replacement is done. But I think globally, banks see it as an opportune time to issue Tier 1 instruments.
And from a buy-side perspective, Mathieu, your portfolio surely includes instruments beyond the European AT1 realm. What are some of your considerations when you diversify away from Europe?
Yes, thank you, Anna, for the questions and for also inviting me. So there's a few things, and we will apply basically the same logic to emerging markets or other jurisdictions. And when we look at a European bank, first and foremost, it starts with the sovereign. You have to be comfortable with the sovereign, the underlying macro trends of the bank you are looking to invest in. And the second one is regulation, is the regulator pragmatic, is the regulatory regime well defined? Do you understand the various triggers or mechanism when things do go wrong, what happens to various parts of the capital structure? And then once you are comfortable with that, then you can go into the credit work, more like the bottom-up analysis, and so that will include traditional credit metrics on either EM or DM bank. That doesn't change much. Actually, EM banks tend to benefit from a much stronger profitability than their most of their DM peers, I would suggest. But the key will be whether the AT1 instruments pricing capture two things in addition to everything else. First is the sovereign premium and the subordination premium. And historically, unfortunately, especially in emerging markets, there was not enough, in our view at least, a sufficient subordination premium between senior and sub and traditional tier 2. I mean, AT1 is relatively recent. But it has changed quite a bit, and I guess some of that reflected the fact that we hadn't had a major bail-in or incidents in some of those countries, and there's still a huge focus on bail-out, which we left more than 10 years ago now in Europe and the United States, certainly. So that subordination premium is a key component of the pricing of the instrument, and the other one is the sovereign. So are you getting compensated for buying an AT1 into a jurisdiction that would probably be a little weaker from the credit standpoint than some of the developed world economy? But frankly, again, that's the same analysis we would conduct for countries even within the Eurozone. I'm sure you can imagine which countries I'm talking about.
We won't mention any names here. But if we are to move on to capital and funding strategies more holistically, and talk about the amount of primary market activity that we've seen this year compared to last year, and it's clear that 2020 has been used extensively for pre-funding, and 2021 has seen less activity. Do you think there will be a pre-autumn rush to the market to make sure that companies and banks in particular benefit from the currently low rates environment? Fred, would you have any views on that?
Yeah, sure. I mean, I think absolutely issuers are looking to get in front of the market currently and bring forward their funding plans to the extent that they already have them. I think part of that actually isn't just locking in low rates, but it's avoiding what could happen later in the year. So inflation is clearly a huge theme at the moment. We've got divergent views from policymakers on the direction of travel for the rest of the year. So we're having conversations with a lot of our clients, less about locking in rates, but it's more like just getting in the market while the going's good. We don't know what's going to happen later in the year. There might be a lot of volatility. While conditions are buoyant, let's not be complacent and bring forward those funding plans.
Would you agree, Patrick or Mirai, from an issuance perspective, from an issuer's perspective rather?
Yeah, I mean, certainly from our perspective, from Emirates MBD, we're already 100% covered for this year. Again, thanks to Standard Chartered for all your help on that. But what I see as well is it's not just banks, but there's new people coming. New corporates are coming into the market, taking advantage of these rates. Our investment bank had a record quarter in Q1, and indeed sort of different variants. So ESG theme is becoming more prevalent. So banks and corporates are we're seeing more appetite or more supply coming from different twists on the traditional, be it loans, syndicated loans, private placements, public issuance. As I said, you don't know what's around the corner. Our attitude is, just take advantage when the markets are good. Take it there, and don't be afraid to pay 5 basis points more, because as we've seen last year, 5 basis points can very quickly become 50 basis points.
Yeah, I'm sure our audience is well aware the differences between how a corporate looks at funding versus a bank. But if I could say a few words on that, I mean, obviously, the advent of TLAC, maybe 5-6 years ago, actually is a watershed event. This means that we're going to have to fund in the wholesale debt markets constantly. So we're not like a corporate where we can see this is a great market, let me be done, and then, sit on the side. I don't need to do funding for a long time. So it's a kind of it's a continuum. So it's not always very easy to say, hey, I accelerated everything and I saved, because you're going to have to continue issue all the time. The second major difference, I think, between us and corporates is, as far as I'm seeing, corporates are focused on rates, whereas banks are mostly focused on spreads. So some of these headline numbers, especially in AT1, you might see that, they're so tight, very attractive levels. But obviously, you have to kind of lift the bonnet and look at what it means in swap terms. So that's the second consideration. And then, of course, thirdly, here, Paddy and I might jump up and down and say, this is a great market. How can we miss it? But then, we have our finance team saying, what, you're going to cost me negative carry. What are you on about? And I think that tussle is probably relevant for every single financial institution globally. So you really have to find the right moment where you can get consensus, especially for banks who say we want to do some pre-funding ahead of upcoming calls or maturities. You got to be careful in terms of how much negative carry you saddle your system with. And then one final point, of course, which is quite interesting. I want to do some preparation for this, and I asked a few friendly investment banks to look at historical relationship between rates and spreads, and at least one of them seems to make a pretty convincing case at the back of data that actually it's inversely correlated. Rates go up and actually spreads come down. So obviously, inflation, rates volatility is not helpful for the market. But I think on a secular basis, probably actually it is not bad news for what might happen to credit spreads. But obviously, we'll all wait and see.
We will indeed. Mathieu, from the buy side, what do you expect will happen, and how will you potentially revise your strategies as a consequence?
When it comes to new issue, so I've actually never really, and we've never really believed strongly into the correlation between issuance and spread performance. It's just when market is very strong, guess what? There is a deluge of issuance, and when market backdrop is weaker, then it's more difficult to issue. That's the one thing that matters ultimately. And so based on that, and to Mirai's point, which is key, and sometimes it's intriguing to see some banks not being more proactive around this issue, is when the market is so strong and available to you, just take it. Especially when you are in build-up mode in terms of TLAC or AT1s or Tier 2 buckets. This is the perfect time to meet your regulatory requirements. One thing Mirai had started to mention is the reason why banks issue TLAC or Tier 1, Tier 2 is because they have to. It's not to please us or some investment banking wizard. It's because the regulators have imposed on them a certain requirements in each part of the capital stack. And so there has been time, certainly over the past 5 years, when it was a lot more difficult just to issue senior unsecured, senior holdco. And so when the market backdrop again is so strong, and you see the extraordinary demand, especially from the US investor base, and look at all the transactions that have taken place over the past 2-3 weeks, perp non-call 5, perp non-call 10, EM, DM, senior, Tier 2, Tier 1, you have book size that are, I don't want to say unprecedented, but are certainly extraordinarily large, telling you that there is demand for this product. And as a result, I would just take advantage of that. Now, from an investor standpoint, if it's such a good market for issuers, it's probably the opposite for investors, but they also have certain mandates at times, and so you just have to be careful in either the credit quality you put in your portfolio at this juncture, or the spread level, as Mirai was mentioning, and then perhaps the duration will be key. So don't put the wrong duration in your portfolio at this juncture.
Absolutely. I think in terms of drivers, we understand that the rates and the unpredictability there is not necessarily a push. Is the updated methodology that Moody's has come up with in the last couple of months something that will be a driver of further supply? Fred, what are your thoughts on that?
Yeah, I mean, clearly these Moody's changes, essentially what's happened is there's been some changes to the exposure measure in the LGF framework, which includes global operations for some banks, whereas previously it was just the domestic balance sheet. So at the margin, for some institutions, it's going to have an impact where this exposure measure is going up, and so it could result in increased issuance for them to stay constant to where they are currently. In terms of this being a structural driver of issuance in the market, I don't really see that happening. I think it's very rare historically that tweaks to a ratings framework will cause structural changes to the market. I think if there are some slight tweaks or increased issuance plans at the micro level for a few banks, I think that will get washed out as a whole in terms of when we're looking at issuance overall. So it's definitely important. Some banks which are more focused on Moody's in particular will be wanting to manage that. I don't think there'll be any knee-jerk reactions where there's a big jump in supply off the back of that framework.
Makes sense. And Paddy, given your rating agency's background, but now also your issuer background, would you have anything to add or any other perspectives?
Yeah, more from the, less from the rating agency background, but when we speak to investors, the sense I get that they don't get hung up on the rating. They use it as one reference point, but they tend to do their own analysis, make their own decision, and almost look for an arbitrage. I look at ourselves, where our secondaries are trading. They're not, to be honest, reflective of our ratings. They're more reflective of higher ratings. So I do think that a well-placed trade, will swamp any benefit that you get from, or any impact that you get from any change in rating approach. I think for issuers, it's the more important thing is how you place the trade, making sure that trying to make sure that it trades well after all these parameters, rather than focusing too much on the rating agency aspect. I think the investors, the primary stop is their own analysis rather than the rating agency analysis.
And Mathieu, would you agree with that whilst ratings are obviously important, they're not a roadblocker or the main determinant for an investment?
No, certainly not. You have to have your own in-house independent research to try to go away from some of the barriers that have been imposed by the rating agencies. Sometimes you don't really know why. And so it's extremely important, particularly when you invest down the capital structure, that you do not rely on third party, whomever that might be, but on your own in-house bottom-up research. So when the agencies are, obviously the agencies, are still extremely important components of the capital markets. It's still core part of the financial markets fabric. And so we have to acknowledge their importance. Some of our clients still require a minimum rating threshold, for example, to put certain bonds into the portfolios. We have also to pay attention to mandate sensitivities. There is still this big split between IG, high yield, EM, DM at times. And so you will have some forced sellers or excessive market move actually both ways. Rising stars, fallen angels is the same thing. And so that has to be taken into account, and that's also an opportunity to add alpha to the portfolio performance. But if you don't have your own, again, in-house research, you will be pushed around by those market forces.
Understood. And the other topic that was mentioned by Paddy earlier, or alluded to rather, is sustainability, which has been gaining a lot of attention over many years. But banks now seem to compete towards zero emissions within the tightest possible timeline. So I'm wondering, what is next in this very ambitious project? Mirai, would you have any thoughts on that? I think you're on mute.
There we go. Sorry about that. So what are we doing about that on Barclays? Obviously, we have announced our net zero ambition by 2050. Since then, our focus has really been twofold. One is we have this new blue track methodology, which is basically account for our environmental impact on our lending activities as well as capital markets activities. We want to make sure that more sectors are embedded within time. We started utilizing our blue track methodology for energy and power sectors last year. And this year, we're now extending them to cover cement and metals. From a relative impact, this level of sector coverage really allows us to capture the most impactful part of the economic activity spectrum in relation to climate change. Secondly, we want to put in place interim targets that will hold us accountable for the progress towards the ultimate ambition. By 2025, we target power portfolio emissions intensity reduction of some 30% and energy portfolio absolute emissions reduction of 15%. We feel that one benefit of these shorter term and realistic targets is that they will allow us to really take stock on our success and areas of improvements as we work on the remainder of our portfolios. We also believe that coordination and cooperation with other institutions and agencies are critical in the whole climate change agenda. And we're very pleased to have become a founding member of what is called the Net Zero Banking Alliance, which, as you know, is an initiative under the Glasgow Financial Alliance for Net Zero. And needless to say, we will continue to keep investors and the market abreast of our progress and developments. Personally, of course, as a funding official who spends a lot of time with investors, I'm scratching my head as to what's going to happen with the whole roadshow concept and sector. But I'm sure, we will find out.
I'm sure we will indeed. Paddy, how are the UAE banks feeling about targets and about the competitiveness of European banks in this respect?
Yeah, it's a very interesting one because coming from a hydrocarbon economy, you could imagine that the challenges here are very different. And I should say that Emirates NBD are at the very early stages in the ESG journey. But we have started that, and we started that not just because investors are asking more questions and becoming want to see our credentials, but we feel it's the right thing to do. So, for us, it's a nice journey, and we're happy to be on that journey. We came out with what we have seen. We've seen a slight change. I think the focus was more on green bond issuance. Now we're seeing more and more issuers and even investors talking about a wider ESG remit. We came out with an ESG linked syndicated loan earlier this year. But, for us, that's really, just to let people know, in a sense, that, this is something that we take very seriously. But some of our peers within the region are certainly more advanced. And, the other thing which is quite pleasing is that, I don't think this is a journey that any bank will, can ever say that they've finished. I think it will keep evolving. But, we get a lot of support from investors, just giving us recognition. Yeah, at least you've started the journey. You may not be on as far as some of your peers, but it's, you've taken that first step, and that gives investors confidence that it's they can still invest in the company, even though we are somewhat further behind than many of our peers.
Makes sense. And we've heard what the strategies and what the aims are for the next 10 years or so. But how does that translate, Fred, into concrete financing structures? We've obviously seen an increase in SLBs, but what do you see there happening next?
Yeah, I think, to be honest, the sustainably linked structures are definitely where the focus is at the moment, just in terms of the structuring teams and what a lot of the banks are talking about in terms of issuance. We've seen a lot of corporate borrowers issue these structures to date, but we haven't really seen that adopted in the bank space, with only a handful of bonds being issued. And a large part of that centres around the step up. So under a typical SLB structure, the issuer is penalised with a coupon step up if it fails to meet its ESG commitments. And that step up causes a bit of a headache for issuers of regulatory instruments. So as Mirai touched upon, almost all of the public benchmark issuance now from European and US banks is to meet DLAC and MREL requirements. And in the regulator's eyes, this step up creates an incentive to redeem. And so at best, that can shorten the effective maturity of an instrument. At worst, it can exclude it completely. So I think, at least in the bank space, there'll be a lot of work on how we can make these SLB instruments work for financial institution issuers. And there's a couple of ways around it, frankly. I mean, the most straightforward is just to attach this structure to a non-regulatory instrument, so an operating company senior or a senior preferred issuance. Another way around it would be to have the coupon step up in a bullet instrument, and that occurs at maturity, so you're not combining it with a call. But we're also seeing other innovations in the market now. So even this week, one of the penalties for missing a KPI rather than a coupon step up was to make a donation to certain obligations. And I think it'd be interesting. Matthew's probably going to hate this one, but there's also now talk of coupon step downs. So a bit less stick and a bit more carrot for the issuers, whereby in theory they would be rewarded with a coupon step down if they meet their KPI commitment. A recent bond issuance from a European bank, they actually had that in their framework, but they decided not to use it. But that's where I think the main thrust is at the moment. I think the UOP structures are generally seen as a bit more standardised now, and I think a lot of attention is going to be on this sustainability linked product.
Yes, you mentioned goals-based coupon step outs and now step downs as well. And there are other structural loopholes and penalties that have been embedded within SLBs to keep issuers focused. Matthew, do you think these penalties are strong enough? And that also links to a question that we've received from our audience. So any thoughts from the buy side there would be very appreciated.
Yes, so a few things, and I consulted with my ESG colleagues before joining the panel here. But so we have to differentiate, unfortunately, financials and non-financials. Clearly, it's a lot easier, I think, to structure KPIs, linked securities, coupon step up, usually, not down. For corporations, it is a lot more difficult for banks. I agree with Fred that a funding instrument as opposed to regulatory instruments could be a good place to start. But you need to take a step back, okay? It's a bit like green bonds. All of this, if it's not accompanied by a proper top-down review of the strategy of the firm, a very clear and consistent message coming from the board, the CEO, about what are the key strategic goals of the institutions to achieve either net zero or whatever other goal they ascribe to themselves. If we don't feel that being embedded into across the firm, then SLBs, green bonds will just be, to exaggerate a little bit, a gimmick that will not necessarily achieve much in the long run, and that will just be short-term fixes to pretend that the bank or the corporate is trying to move forward. But what we need first and foremost, and then we've seen already several banks coming out with a pretty comprehensive review of their ESG or green strategies, and when we see that, that's a lot more encouraging to us, and we will certainly be a lot more willing to support those efforts rather than a bank that just start with a narrowly defined green bond program or green framework or social framework for that matter, or an SLB bond, without having this overarching well-defined strategic program at the group level. The other thing I would point out is, unfortunately, but I guess it's just because it's not the beginning, but we're still in the early innings of this practice, is we still lack consistency in the disclosure from issuers, again, be it financials or non-financial institutions. So we would certainly be supporters of greater harmonization, greater transparency of the KPIs, of the factors that the banks or corporations utilize when they issue such bond. And I think, for example, the ICMA guidelines were pretty good, so that's a good place to start if people want to see how they can align their framework to something that has been already approved by market participants.
So lots to look forward to, and not yet a lot of convergence towards one single set of standards. That leads me to the next topic, perhaps, and that's IBOR. And although we probably expected more consistency, I think recent issuances have referenced Bloomberg short-term bank yield index. So that creates divergence in this space as well. So I'm wondering, do you think we will be living with multiple reference rates in the post-LIBOR world, or will there be more harmonization going forward? And maybe if I can come back to you, Mirai, on this question.
Yeah, fair question, and the answer is I do not know. We've all seen the Bank of America BSBY linked trade. I think supporters of SOFR were very quick to point out how SOFR daily volumes completely dwarf any volumes you see on BSBY. So on that measure, you would have thought that the future is still SOFR. But obviously, there are certain constituencies on the issuer side. I don't think Bank of America is one of them, but perhaps smaller banks that might prefer a credit-sensitive spread. But the jury is out on that. I think all I can say as a large, frequent issuer is, we're going to have to adopt or adapt ourselves to what investors want to invest in. I think up until now, all the body language, feedback, ARC's recommendation in the US pointed to SOFR, BSBY, and I don't think BSBY is the only alternative. There is probably one or two also being talked about. We're going to have to see if we find out that large investors prefer one index over the other. Then, like every issuer, I think we're going to have to make preparations to issue in that format. But currently, I think it's still SOFR winning the day.
And Patrick, do you have any other views in addition to what Mirat has just shared with us?
No, I mean, I fully reiterate what he said. In a sense, as an issuer, you want to issue something that the investors want. So, it is a bit of uncharted territory, going ahead, and all we can do is build in replacement language and wait and see, how who wins the day or what wins the day. I would be reluctant to sort of, plant my flag in one camp. I really want to see, investors will drive this decision for issuers.
Great. And before we wrap it up, shall we ask what the investors actually want? So, Mathieu, if you have any thoughts on that, or indeed, if you'd like to highlight any of the risks or concerns around the transition, the LIBOR transition.
Yeah, it's a very topical issue and very important one. It's a bit like, the green/SLB bonds we were discussing before. One of the key risks I see is a regulatory intervention. If a regulator comes in and disqualifies a bond because it deems the fallback language unacceptable, or it deems that there is a step up, which is an incentive to redeem, or whatever, it disqualifies the capital instruments, and so you have a regulatory park-hole, and it's I think is detrimental for everybody ultimately, including the issuers. So you look at the UK, which has taken the lead on the IBOR transition. Clearly, the FCA and the Bank of England have been extremely clear in what they would like to achieve, and so we've already seen towards the end of last year, and I think clearly Barclays was one of them, several successful consents from transitioning old-style LIBOR-based securities into SONIA plus spread, and again with the help of ISDA here, so an industry body, and that has been quite successful, well taken by the market. And I think that today you have another one from a UK insurer, and you've seen a few more during the first quarter. So we would certainly be supportive of that whenever it makes sense and whenever it's fair for both the issuer and the investor. But clearly the regulatory risk is something we have in mind. The other risk is liquidity. If for whatever reason the investors can no longer hold, or it's becoming a lot more difficult to invest into, again, LIBOR-based securities, then you will see the liquidity in those instruments decaying over time to a point where it's no longer representative of the funding levels of the institutions, and so the clearing level will be a lot lower in cash price, a lot wider in spreads. And so I do think, again, it will be detrimental for both the investor who is left holding the bond as well as the issuer, because its access to funding will be distorted by that or those securities that have been left outstanding and unaddressed from a LIBOR standpoint. So, yeah, liquidity and regulatory risk are two clear and important issues we bear in mind whenever we look at IBOR transition.
Perfect. We'll probably have to leave it at that, but it's a full circle. We started and we're ended now on a regulatory tone. So thank you very much for your time and for your answers, and thank you very much to the audience as well. And we'll see you next year, hopefully in a non-virtual format.
Thank you.